So let's bring in our market panel. Dan Skelly of Morgan Stanley Wealth Management and Emily Bowersock Hill of Bowersock Capital Partners. It's great to have you both here. It does look like maybe the Dow is finishing slightly lower. I can't totally tell on my screen. But we did finish higher on the S&P and the NASDAQ to finish off the month here. Dan, I want to start with you and the fact that typically this is such a weak time of year, and we did actually see that sell-off halfway through the quarter. The fact that we regained ground and then some tells us what about this market?
Well, first, it's great to be back with you, Morgan. Thanks for having me on. So, look, we went down the elevator in late July and early August. We had a 9% drawdown extremely quickly. And as you noted, we came back. And I think what the comeback has really signaled is more strength and more resilience in the economy, tracking close to 3% GDP still. And finally, confirmation that Powell and the rest of the Fed is going to get ahead of any further labor weakening. And so I think it's just more confirmation that the runway to this soft landing is finally in sight.
And Emily, I want to get your thoughts on what Powell did have to say, the Fed chair did have to say this afternoon that did ding markets, at least temporarily here, especially given the fact that Fed officials have been leaning a little more dovish post FOMC meeting and that 50 basis point hike. Have a listen.
This is not a committee that feels like it's in a hurry to cut rates quickly. If the economy performs as expected, then that would mean 2 more cuts this year, a total of 50 more.
Which we know, Emily, is what the dot plot is indicating. However, we are also ahead of a busy week of macro data, including, of course, the jobs report on Friday. How much is going to hinge on that?
Well, first of all, I would say that Chairman Powell is remarkably adept at packaging and marketing Fed decisions. So he is able to come across as calmly proactive, even when the Fed is doing something like cutting rates 50 basis points. And one of the ways he does that is by very carefully telegraphing his plans along the way. And that is part of what he was doing today. With regard to the jobs data, I would agree with Dan that we are seeing a very resilient economy. And 3% GDP growth, I would expect jobs to come in line with expectations. I think the economy has proved remarkably resilient during this period of rising rates. And the fact that inflation is now down to 2.2% and is essentially, in our view, in remission, gives the Fed room to do exactly what they said that they were going to do, which is cut twice at a quarter point each before the end of the year.
And Dan, you seem to be saying that maybe we can take our eye off the Fed a little bit, like relatively speaking. There's been so much talk about, oh, how much is the Fed going to cut? Is the Fed going to do this or that? You're saying that right now with the S&P at about, 21 times earnings, the economy is the key to the performance of stocks from here? I mean, we get to pay attention to the economy?
Absolutely. And by the way, that's what some of the daily and weekly trading trends have told us over the last several months, is that the economy is becoming way more important. And so, look, I think you have to think about and respect the rotation that's happened over the last 3 months or so. I know we'll get into it. But looking out into next year, you can't have both this aggressive Fed cutting that's currently priced by Fed funds and reach these 15% earnings expectations. So frankly, we come out a little bit more confident in the idea of having better earnings than we do that the Fed's going to need to aggressively cut from here.
And Emily, you expect a strong fourth quarter, similar to the third, you say, but not without some chop.
A lot of this depends on, as we know, the market likes certainty. And I think we need a decisive outcome in November. And it's not entirely clear that that's going to be the case. The best outcome for markets would be, Harris as president with the Republicans holding the House or the Senate or both, so that we would have divided government. The worst outcome for the market would be a protracted period of uncertainty, legal challenges, violence in the streets, all of which are possible, as we know. So I think, yes, we think that the market was set up in the third quarter for a very strong finish, but I would expect volatility to continue and for that finish to be strong once the elections in November are resolved.